All right, welcoming in on the Voices of Wall Street. We have a very special guest today. I'm excited to welcome him in. I keep saying that we've got the best guests at the best times, and today is no different. We've got Brian Barnes. He is the founder and CEO of M1 Finance. He calls it the super app. The finance super app, excuse me. Let me make sure I get that correct. Brian, thank you for joining us on the Voices of Wall Street.
Yeah, absolutely. Thanks for having me.
Thank you. First of all, let's just jump right into us. For people who don't know, talk about what M1 Finance is and how it differs from, other apps out there like Betterment or Robinhood or some of these others that people know about.
Yeah, absolutely. So you talked to, we call ourselves the finance super app. And so what we're trying to do is handle all of a retailer's consumer or, an individual's personal finances. And so we define that as how they invest, borrow, and spend their money. And what we do is we personalize it so people can create a customized, personalized plan. They can then automate it, and we do it for either free or incredibly low cost. So M1 has 3 products. M1 Invest is our first product, and that's free automated investing in a custom stock or ETF portfolio. So users come to the platform, they design a portfolio of the stocks and ETFs that they want. If they're unsure, we have a bunch of templates available for them. Really intuitive way to construct and organize that custom portfolio. Once the portfolio is designed, you just allocate money against it. So you can deposit, 500, 1,000, 10,000, 100,000 into this custom portfolio, and it all goes to work for free. And we're doing a lot of intelligent things in the background with where we direct money and fractional shares to put that money to work in that custom portfolio. We then Sorry, go ahead.
Sorry, no, I was going to say, I think that's the key, and that's what makes you guys different from a lot of what's out there already, because, you've got robo-advisors, you've got, obviously, your traditional fund managers. It seems like this is something like a robo-advisor, but it's free. But talk to me about how that works.
Yeah, so if you take a traditional robo-advisor, Wealthfront, Betterment, the ones that the brokerage firms or banks have come out with, they typically assign you a portfolio of 6 to 10 ETFs, and then they automatically rebalance for you. What we've done is we've taken the automation of those robo-advisors of you can deploy money against that portfolio, much like it's depositing into a savings account. You just transfer money, it all goes to work in your investments. But what we've done is we've lowered the cost. And so instead of charging, a quarter of a percentage point, we're 100% free. And we allow for unlimited flexibility and customization. So you can pick individual stocks, you can pick individual ETFs, you can group them together. And so it allows you to enact and invest in the portfolio that you want rather than the portfolio that the robo-advisors tee up for you. And so, it's for the person who actually wants to make investment choices and say, I want to own these securities because I think they're undervalued, or I like the product and I believe in the long-term value accretion of them. And so it's a little bit more geared towards the self-directed investor. What we do is we provide a layer of automation and reduce the cost of investing.
Yeah, so how do you do that, though? Because obviously you're a business, you've got to make money. You're offering this thing for free that other people, as you mentioned, are charging. And, I think fees were the lowest they could go. And you're saying, no, we can give you more and it's free. How do you do that?
Yeah, so if we just look at the Invest product, we can make money in 3 main ways. One, people can hold cash in the investment portfolio. And so typically about 6-7% of our total assets on the Invest platform are held in cash, which we can monetize much like a bank monetizes their deposits. We can also do what's called Securities Lending, and that is taking the securities that our users own and lending it out to people who want to borrow it for short sale purposes. They pay M1 interest on borrowing those securities, and it allows us to offer the service for free, and we can monetize in sort of these back-end custodial fashions. And then there's this, sort of boogeyman in the industry, payment for order flow, but we do get paid to transact on various exchanges. I don't think it should be a boogeyman. I think it's a boogeyman because of the complexity and the opaqueness, but it's a way that market makers pay for order flow to reduce the cost of trading. And so you add those 3 together, and we actually make higher than robo-advisor rates despite giving the platform away for free. We also have 2 other products, M1 Borrow, where we're lending money out, and M1 Spend, which is an integrated checking account. We also make money on both of those. And so for people who are using M1 as their primary financial institution, we can offer a incredibly valuable experience and not charge the customer for it.
Yeah, I think what's really interesting about your model is that you're doing all the things that Robinhood or some of these others are doing but then not doing the other things, right? Like, I mean, Robinhood also is charging to lend out securities. They're also making money on those additional cash deposits that their users have. But then they also are doing things on the back end. And it seems like, and that's the same thing. I shouldn't single Robinhood out. TD Ameritrade, E-Trade, Schwab, whoever it is, they all do those things as well. You guys are making a living on just that. I have to imagine, though, that makes your margins really thin.
Yes and no. It's thinner than if we were to explicitly charge as well. But if you look at, just a few years ago before all these brokerages, Ameritrade, E-Trade, Fidelity, Schwab went commission free, Schwab was making 90% of their money outside of commissions. Ameritrade was making 70% of their money outside of commissions. And so, you looked at it and commissions were a portion of their business, but it wasn't a super meaningful component. And really
this is true. Yeah, but Brian, if you don't mind if I say, but as they've transitioned away from that model and to this commission-free model, a lot of them are having trouble making money. I mean, Schwab's last quarter earnings were rough.
Schwab is a $130 billion company, I don't know if they're necessarily having trouble making money. If anything, I think that they make too much money.
Well, they're having trouble turning a profit, I should say. I shouldn't say making money.
I think they're having trouble monetizing at the same rate that they did when they were charging their customers in addition to these back-end revenue streams, especially in the interest rate environment that they're in. Schwab turns a very large profit and will be profitable for the many decades to come. I think it's M1 came to this scenario and said, we can operate our entire business on a subset of the revenue streams, and we're going to make up for that in efficiency. So the vast majority of the things that we're going to offer are going to be powered by software and automation rather than manual, old, outdated platforms. And so, if you look at it, Schwab has, 50,000 employees. M1 has 150, and I think we're able to scale in a incredibly cost-effective way and offer a better investing experience, a better borrowing experience, a better spending experience, and we will continue to improve on that over time. And so I think it's the power of software and automation on both the front end and back end that allows us to automate and strip out a lot of the costs of providing these services to the end customer.
Okay. And you talked about, before we switch gears, but you talked about that boogeyman, as your word, of payment for order flow. And there's been a lot of talk about that. Public.com recently said they're getting rid of it. They made a whole thing, advertising campaign about abandoning payment for order flow. You guys are still doing it. Has there any thought to going to the tipping model that Public has put out there, or doing something similar?
We haven't thought about going to the tipping model, and I think it's a boogeyman because it's relatively opaque, and the people that are paying it are these firms like Citadel and Virtue and the like, and Jane Street. These are big hedge funds that make a lot of money, and so I think that there's sort of a assumed nefarious action. I don't think that's actually true. If anything, what they're competing on is providing better pricing for the trades that are executed. It's a little bit of a weird mechanics, but they're transacting at prices between the spread, whereas if you went to public trade, you would get the prices at the spread or the NBBO. Right. And so, it's a more cost-effective way to execute trades. It's price improvement for the end customer. And the firms that are doing this rebate a little bit back to the broker for facilitating that and making that happen. Really, we think that it's a little bit of losing the forest through the trees when we focus on payment for order flow. And what doesn't matter is payment for order flow, but what matters is investing versus trading. If you're a frequent trader, it is costly from eating the spread. There's the payment for order flow. It's tax inefficient. There's not a real basis for what a stock is worth at 10 a.m. versus 2 p.m. and trying to game that market. And so that is really what is expensive for the retail consumer versus buying ownership stakes in companies and letting the underlying company appreciate in value over long periods of time and having your ownership reflect that. So, we think any concentration around payment for order flow is concentrating around trading, which is an activity that shouldn't happen that frequently. People should be thinking about, buying investments for long periods of time and benefiting by the ownership value rather than the sort of random price movements in any given day. And so, payment for order flow, like more than happy to go into the nitty gritty of it, but I
No,
do think
let's not do that. Let's not do that.
I think just high level investing versus trading is a, I think, more interesting dichotomy. And all these brokerage firms, I think, if they're benefiting their retail customer and benefiting their financial wellness, their financial health, their overall wealth, they would be encouraging long-term systematic investing behavior, not short-term trading behavior.
Right. All right. Well, that's you sound like an old school fund manager. And you guys have, I think it's what, $3 billion assets under management right now, or what is the current
approaching
number?
4? Yeah.
Approaching 4? Okay, wait, how close to 4? What are we talking?
Very close. We'll announce it. So we crossed $1 billion in February of 2020, and so in March of 2022 we're close to $4 billion, and so have 4x over the last 12 or 13 months.
Okay, you don't want to announce it here on the Voices of Wall Street?
We're not quite there. I would love to. Invite me back on when we're over it, and I'll make the announcement here.
All right. You've also you talked about the growth. Also raised a good bit of money. I think $153 million in the last 9 months. Why is it that these investors and these customers are coming to you? I mean, it seems like I said, you're preaching the kind of old school fundamentals, investing for the long term, things like that. Why is it that you're so popular in an environment that seems to be the opposite of that?
Every single person in the country has to manage their money, and they're always looking for the best available tools. And whether that's, budgeting more, saving more, investing more, spending more, prudently and getting the value associated with that, everyone's always in search of the best tool for their money management. I think if you look at the incumbents, whether that's the big banks, the big brokerage firms, they haven't really adapted to the modern times, that consumer applications are better outside of finance than they are inside of finance. And I think they've been protected from competition for a long period of time. You have a lot of fintech companies, these new entrants saying, hey, we can offer better product, better pricing that, fundamentally serves the customer in a better fashion with using a 2020 toolkit, whether that's software, the application design, UI paradigms, mobile, web, building it on a digital infrastructure, I think is just a big advantage to a sort of retail brick and mortar branch model. And so it affords the ability to be quite innovative in the space. And so, M1 was able to start with a blank slate, really sort of design from the ground up of what does the ideal personal finance application look like? How does it integrate investing, borrowing, and spending? And I think we're just resonating with the customer that we deliver a better money management experience than a lot of our, the incumbent banks, the incumbent brokerage firms, and they're putting their money where their mouth is and using M1 to manage their life savings.
Yeah, and look, it seems like investors feel that way also. Any new developments or products in the pipeline that you guys are looking to roll out right now to help you better compete and, maybe get those billion-dollar investments?
The investors putting money behind the company is, great validation, and it sort of talks to the opportunity that creating a financial institution that is on the same legging as a Schwab, a Fidelity, a Bank of America, a JP Morgan Chase, that's a very valuable proposition, and they're willing to bet on M1 to build and create that. But that's a long journey. So, that's many decades to create that.
But Brian, on that long journey, do you have any products coming out that you can tell us about?
Yeah, for sure. So, what I was, getting to, we have our 3 main pillars of invest, borrow, and spend, and we are going to go deeper in each. So on the investing portion, there will be more and additional investing options, as long as more performance, more research capabilities, more analytics on what you're doing and choices to be made. On the borrowing, right now it's a portfolio line of credit, so it's secured against your investment portfolio. We'll move into other forms of borrowing, whether that's mortgages, HELOCs, personal loans, auto loans. We'll always be focused on lowest cost and most flexible terms. And so we should be able to offer better lending options than any of the bank or other lending facilities out there. On the spending side, we offer high interest checking account as well as debit card. We're moving into the credit card space, and so that will be able to have higher rewards, higher spending limits, more personalized things, and then we're going to incorporate it with our investing platform, so rewards based on what's in your investment portfolio, as well as using the borrow line of credit to ensure that you're always, if you ever need to go to a revolver, you're always paying low interest instead of sort of getting defaulted into high credit card debt.
Okay. And the last question I'll ask you is just about expansion, because I know obviously the more money comes in, the more investors you're dealing with. That's always right now in the world we live in the biggest question. How do you grow? How do you create scale? How do you come to dominate the market? So what's your strategy? You're looking at expanding into different geographic markets. You talked about the products, but how do you grow and how do you guys really build this into a huge brand if that's your goal?
Yeah, so over the last year, we went from under 100,000 funded customers to over 500,000, and so have considerably grown over the last 12 months. I think we still have some basic blocking and tackling to do with building a scalable platform that can sustain millions, if not tens of millions, of customers, and really that's operating on an incredible product experience, incredible customer support, incredible just operations in the back end to make sure that it's automated and not things don't go wrong. And so we have a lot of just general scaling to do. We've more than quadrupled our team over the last 12 months. We have the plan to continue to double it over the subsequent year. And so, we're moving from an organization that was 40 people at the beginning of 2020 to something that's close to 300 at the end of this year, as well as just continuing to deliver on a fantastic user experience. And so I feel like that's a very vague answer, but we're building across every aspect of the business, product, the organization, all the things that are necessary to support it. And it really is to create that next generation Schwab, that next generation Fidelity, where it's a financial institution. They just were created in the 70s. We think that a 2020 version of that is going to be better suited for the next many decades.
You want to say 2021. I don't think people want to talk about or think about 2020, Brian.
For sure. Yeah. I'll have to catch myself next time.
As Brian Barnes, founder and CEO of M1 Finance. Brian, thank you so much for being with us on the Voices of Wall Street.
Yeah, really appreciated you having me.